Just yesterday in the January 16, 2018 Wall Street Journal, there was an article announcing that General Electric is considering breaking up its business divisions. The article states that, quote, General Electric is considering breaking itself apart, a dramatic move that would mark the end of one of the oldest and largest U.S. conglomerates. The 125-year-old business, which was once the most valuable U.S. company and still employs about 300,000 people, sells everything from airplane engines to hospital incubators. But in the past year, the company that came to embody America's industrial power has fallen on hard times, prompting it to change CEOs, sell assets, and slash its dividend. Close quote. The article included this graphic, which shows that its nearly 300,000 employees are currently spread out across a wide range of different types of business units. GE Capital, for instance, employs about 6,000 people in the financial services industry. GE is planning on focusing on just 3 core units: aviation, power, and healthcare. The other business divisions will be carved off into their own separate traded units. The breakup in the GE conglomerate is an example of a change in corporate strategy. So far in the course, we have concerned ourselves with business strategy or competitive strategy, which applies to a specific business or business unit which competes in one industry. In conducting business strategy, we have been concerned with the question of how to compete, or in other words, how to create competitive advantage for the business unit. But what if a company competes in multiple industries like GE? We can think of the company as having multiple business units, each with its own business or competitive strategy. Such a company would be involved in corporate strategy. When conducting corporate strategy, we are concerned with the question of where to compete. When conducting corporate strategy, we are deciding what businesses or industry the corporation should be in, how the corporation should manage the various business units, and how to enhance the competitive advantage of each business unit. Consider 2 firms, Firm A and Firm B. Firm A manufactures auto parts and Firm B produces auto glass. We are considering acquiring the 2 companies and placing them under the control of a single corporation. Ideally, when the 2 companies are under one corporate head, the combined value of the 2 companies will be increased. We call this a diversification premium. This would be the case if Firm A was worth $50 a share, Firm B was worth $25 a share, and once merged, the new value was $80. In this scenario, the corporate whole adds up to more than the sum of its business unit parts. Unfortunately, more often than not, a diversification premium is not the outcome. More common is a diversification discount. This happens when the stock price of the diversified firm is valued at less than the sum of its individual business units. This would be the case if the combined stock value of Firm A and Firm B was less than $75, $60 for instance. For a diversification premium to be possible, there must be positive externalities or synergies between the individual business units. Competition takes place at the individual business unit level. For it to make sense to put a business under a corporate head, the corporation must be able to enhance the competitive advantage of the business unit. Negative externalities are also possible. Whenever a business unit is acquired by a corporation, there are costs added to the business unit. Business units must deal with corporate management, systems, and policies. This lends itself towards a diversification discount. It can be tempting to justify corporate strategy on the basis of portfolio diversification. However, it is easier for shareholders or owners of the company to diversify their individual portfolios than for a corporation to diversify by acquiring additional business units. Another difficulty in making corporate acquisitions of business units profitable is that the cost of entry can be high. Attractive industries usually have high barriers to entry, and high barriers to entry eat profits. Strong market forces can also undermine potential profits. When a corporation sees an opportunity in acquiring a business unit to actually profit off the acquisition, it must be the case that nobody else sees the opportunity. If multiple bidders see the unrealized opportunity, the acquisition price will be bid up until the price reflects the expected profits accruing to the buyer. So for corporate diversification to make sense, there must be significant positive externalities between the business units. The corporation must be able to strengthen the competitive advantage of the business units. This goes beyond some broad notion of fit. Michael Porter suggests that synergies are most likely when corporate diversification enables sharing of activities or skills in a way that enhances the competitive advantage of the business units. An example of sharing activities might be Procter & Gamble. Procter & Gamble has a very large distribution network and relationships with many vendors. When it acquires a new product, it can leverage its existing distribution network and relationships to get the new product on shelves in many retail locations across the nation. In this case, we would expect the acquisition to increase the value of Procter & Gamble by more than the business unit's stock price. That is, there would be a diversification premium.